Previous two chapters, we discussed output and pricing decisions under different market arrangements and different levels of competition. Now we're going to continue the idea of pricing decisions, but we're going to do so in specific situations. And we're also going to add some complications that we didn't deal with in the previous two chapters. All right, so we're going to look at a few different examples of special pricing policies. We'll begin with cartel arrangements. I think the most obvious example of that is OPEC, the oil producing cartel. Then we'll move on to price leadership, something we mentioned a little bit in the section on oligopoly. We'll dig into more detail on that. We'll look at revenue maximization. So instead of firms that are trying to maximize profits, in some situations they may try to maximize revenue. We'll talk about why that is and then how the firms are going to make decisions within that context. We'll move on to different types of price discrimination. Sometimes some consumers are going to be willing and able to pay more money than others, so it makes sense to charge them different prices based on that willingness. And we'll look at non-marginal pricing, pricing for multiple products, and we'll end with a brief discussion on transfer pricing. Competition is great for consumers. It leads to low prices and innovation and long-run improvements in quality. But businesses don't like competition. It's tough for them. In a recent survey by Matt Mitchell, he asked business managers their opinion on competition. Unsurprisingly, they loved competition in all the other industries. But for theirs, no matter which one, they said it suffered from special problems that necessitated some form of regulation. And this regulation just happened to make entry into the industry more difficult and costly for future potential competitors. Every business must operate at the most efficient level of cost, or the minimum cost, in the long run, to earn an economic profit. There's always an incentive to become more powerful than their competitors. If firms become more powerful than their competitors through offering a superior product at a lower price, this is great for consumers. Consumers are made better off, and the company is growing because of that. But this isn't always the case. Sometimes firms agree to act in concert, act as if they were a monopolist, in order to increase profits. They end up doing this by setting output artificially low, driving the price per unit up. Adam Smith warned of this in The Wealth of Nations, that anytime members of the same industry meet at night, it's to force higher prices on consumers. So a cartel is an agreement where firms and industry cooperate and act together, and they do this as if they were a monopoly. They agree to all voluntarily set limits on their production so that the entire production of an industry meets a certain level so that they can all charge a certain price, higher price than would be efficient in the market. In order to protect competition, cartels were made illegal by the Sherman Antitrust Act in 1890, and these penalties were strengthened by the Clayton Act in 1914. So because of this, most official cartels are found outside of the US. OPEC is the best example for the oil-producing countries. There's also one for international air transport that US airlines are allowed to be members of. In the US in the 1960s, there was an electrical price fixing scandal in the US. It went through the courts, and several executives ended up in jail because of it, because they broke Sherman and Clayton. In order to be able to form a cartel, certain conditions must be met. So cartels are common in oligopolies because it requires a small number of firms. Transaction costs would be too high if there were a large number of firms. And these firms also need to be geographically close, or at least headquartered close to each other. Being geographically close, combined with a small number, helps for the enforcement of the cartel agreement. Members of the cartel do not want one to go off on their own to break the agreement and then offer their product at a lower price. That would break the cartel, and the one that cheated would gain a lot of market share at the expense of the members of the cartel that didn't cheat. The product has to be homogeneous. That's why I mentioned oil, electric, and air travel as these examples, because you can't have members of the cartel competing by differentiating their products. Again, that goes against the whole point of the cartel. Cartels often form during a recession, during that stage of the business cycle, but they can break apart at any point in the business cycle. Typically, it's when prices are decreasing and the economy is entering a recession that firms try to compete against each other by lowering their prices as low as possible. That's when they would naturally try to come into agreement and say, hey, let's all hold our prices higher so we can each profit as much as possible. Entry into the industry must be difficult. New competitors joining the industry and beginning to compete would not be bound by the agreement, so they could sell at a lower price and begin to gain market share at the expense of all the cartel members. And you need each member to have similar costs and fairly similar market shares. This will help prevent cheating again. So that way, you don't have a small member agreeing to join the cartel just to hold back, tie the hands behind the back of all their competitors so they can gain some market share at their expense. The ideal cartel would be powerful enough to establish monopoly prices and maximize the monopolist's profit. They would act like a single entity, so we analyze the market like we would a monopoly. Now, this is not just in theory, the firms would literally be getting together to make pricing and output decisions like a single entity would. The cartel is going to determine the output, which is going to equate to the marginal revenue equals marginal cost rule for the entire cartel. Again, just like a single monopolist would be doing. The marginal cost of the cartel as a whole is the horizontal summation of all the members' marginal cost curves, which we're going to see on the next slide, so that phrase actually makes sense. The price is going to be set in the normal way the monopolies would do it. So they're going to determine the quantity demanded, where the marginal cost equals the marginal revenue, and they're going to derive the price that they sell at from tracing that point up where they determine that quantity, where they determine up to the demand curve. So now in this market, let's assume that we have two oligopolists. We'll keep the number small for simplicity's sake and to keep the analysis easy. So company 1 is going to be in panel A. They face a marginal cost curve M1. And company 2 is in panel B. They're going to face a marginal cost curve of MC2. So for the entire market, we're going to sum those two together. Or we said the linear combination. That just means the sum of them. And the whole market's marginal cost curve is going to be MCT, and that's in the third panel. So the cartel, aka the monopolist, is going to face a downward sloping demand curve and marginal revenue curve. Again, just like we saw in the monopolist market, we're using the same exact analysis here. And it will decide to produce where the marginal revenue equals the marginal cost. That's going to determine the quantity of the output, in this case QT. We're going to call that because it's the total market output. So we're going to find the price that the cartel is going to charge for their product by finding the demand curve at the point QT, and that's going to be a price P. Once we've figured out how the market price and quantity is determined, we can then turn to individual firms. Each company is going to sell at the price determined in the market from the previous slide because of the cartel agreement. So we trace where the marginal revenue equals the marginal cost for the cartel over each of the members. Where that dashed line crosses each of their curves. That's going to determine for firm 1 and firm 2 their level of output Q. Now, depending on each firm's cost, they're going to have different profit levels. So firm 1 has higher average total cost, so they're going to end up with a lower profit, as we see depicted by the blue shaded rectangle. Company 2, on the other hand, they're going to have a much lower average total cost, so they have a larger area of profit. And the key points to remember here is that the marginal cost is the same for both firms in the cartel. Again, because we're tracing from where the marginal revenue equals the marginal cost for the total industry, we trace that back across the marginal cost curve for each horizontally. So we're going to hit each marginal cost curve at the same point. We would expect firms in a cartel to have different profit levels because they're going to end up having different costs. Even if the different costs that they face are small, there's still going to be some difference. Odds are they wouldn't be exactly the same. Now, even though some firms are going to earn higher profits within the cartel than other firms in the cartel, the overall level of profit for the entire industry is going to be maximized by the cartel. Now, because there's different levels of profit for firms within the cartel, there's going to be an incentive for firms to cheat on the agreements. That's why cartels are unstable inherently. So because one firm can offer a slightly lower price, they can cheat on the cartel and use that to capture market share from one of their competitors. They're going to be incentivized to do that in the long run. And there's costs of creating and maintaining a cartel. So first, there's the transaction cost of just forming the cartel, getting the entire agreement together, especially because it's illegal. You have to have shady backroom dealings. Additionally, monitoring each member of the cartel is going to be costly and difficult. You're going to have to spend a lot of time and money and hire extra personnel whose sole job it is to make sure that your competitors aren't acting like your competitors, that they're agreeing and abiding by the rules of the cartel. And there's enforcement costs when someone actually breaks the agreement of the cartel, punishing them in some manner. And finally, there's a potential cost of punishment from authorities, at least within the United States, where cartels are illegal. Now, your textbook gives several examples of price fixing by cartels in U.S. history. And I won't go into all the details about this, but you can read about them in your book if you're interested. But in like these cases, the leadership of the companies were caught. They were punished severely. The companies punished with fines, and some of the leaders of the company actually punished with jail time for breaking the Sherman Antitrust Act and the Clayton Act. And requires constant monitoring by antitrust authorities to make sure that these agreements aren't going on. Oligopolists may not legally be allowed to form cartels, and those cartels that do form may be difficult to maintain. But oligopolists do have other pricing practices available to them. One such alternative is called price leadership. Under price leadership, there is no formal agreement on pricing between the firms in the industry. However, when one firm changes, all the others choose to follow them. The first type of price leadership is called barometric price leadership. So under barometric price leadership, basically one firm decides to initiate a price change in response to economic conditions, and then the other firms typically follow. If that initial firm judges the industry and the broader economic conditions correctly, others are going to immediately follow them. If they misjudge, however, others likely will not follow them and they'll keep their prices at the previous level. The textbook provides an odd example of airlines back in the 1990s where airlines were raising and rescinding prices based on whether firms followed them or not. But over time, due to either changing market share or to new entrants into the industry, the price leadership can change. The other type of price leadership is dominant price leadership. So when an industry contains one company that sets itself apart by its size and its market share compared to the other firms, we end up with dominant price leadership. And this is normally the most efficient or the lowest cost producer in the industry. That allows them to grow to a much larger size than their competitors. Now this dominant firm is able to set their price with the knowledge that the smaller firms within the industry are going to have to follow them and charge the same price. If the dominant firm in the industry chooses to lower their prices too far, below their opponent's average total cost, this is going to force some of the competitors out of the business, or allow the dominant firm to buy them under favorable terms to the dominant firm, but unfavorable terms to, obviously, those small companies. But the dominant firm has to be careful with this. If they buy too many of these, especially if it's due to a series of price decreases, that's obvious, it'll result in a DOJ investigation under the Sherman and Clayton Antitrust Acts. So they have to be careful when doing that. So let's look at a theoretical example of dominant price leadership in action. So for this industry, the entire demand curve for the industry is represented by DT on the figure on the right. So the marginal cost for the dominant firm is upward sloping. It's going to be MC subscript D. MC subscript R is the sum of all the marginal cost curve for the following firms. So in setting their price, the dominant firm has to account for the amount supplied by all firms, and that's what they're going to end up influencing. So the demand curve for the dominant firm is labeled by D subscript D, and the marginal revenue for them is below that at MR subscript D. The price is going to be set by the dominant firm where their marginal revenue equals their marginal cost. So in this case, where MRD equals MCD. This corresponds to the output A in this example. To determine the price that the dominant firm is going to sell at, trace that quantity up to the demand curve DD for the dominant firm, and they'll set the price at that point. So in this case, price P. Because the other firms are all forced through market pressure to follow that price, trace that price horizontally out to the market demand curve DT. That's going to determine the overall industry output. The dominant firm is going to supply the quantity A, so the followers combined are going to supply the quantity QT minus A. Now, this type of agreement is satisfactory for the dominant firm. This is something they would like. The reason they like that is it maximizes their profits, and at the same time, it allows these smaller firms to exist. Initially, you would think, well, why would they want to keep those smaller firms in business? But remember, if they drive out all their competitors or buy out all their competitors, they're going to get investigated by the DOJ, get slammed by Sherman and Clayton. On the other hand, the followers will be able to assure themselves that they can have some of the market without worrying about a price war. So say the dominant firm decides to increase their prices, the smaller firms are going to follow them and increase their prices. If they kept their prices low, eventually that large firm would say, I can't deal with this. Let's put these guys out of business, lower their prices, and take away their market share. So smaller firms are able to exist by following the price leader. Now, just like cartels, dominant price leadership arrangements tend to break down over time. So as markets grow, new firms are going to enter the industry, and we'll see less interdependence among firms. We'll move slowly from an oligopoly to monopolistic competition if the barriers to entry aren't too high. Additional technological changes can bring about changes in pricing and in the cost structure of the competitor firms, in this case, the following firms. If they're able to lower their costs substantially, they can then begin to grow in size because they lower their prices and take away the market share from other followers and from the dominant firm. Another method of oligopolistic behavior is revenue maximization instead of profit maximization. So this is called the Baumol model after the economist William Baumol. Under his model of oligopolistic behavior, firms maximize their revenue instead of profit, subject to maintaining a specific level of profits. So they want to establish a minimum level of profitability. Once they hit that, they try to maximize their revenue, anything above that. So the rationale behind this is twofold. First is that when a firm achieves a larger size, it'll be more competitive. It'll be stronger against their competition. And the second is that often management is paid related to revenue instead of overall profits. So the implication of this model is that unlike when firms are trying to maximize their profit, a change in fixed costs will alter the price and output because it raises the cost curve, lowering the profit line. Figure 10.3 here will help illustrate what the hell that just meant. So total revenue is upward sloping and then downward sloping. This is because the firm faces a downward sloping demand curve. The total cost curve here is upward sloping at a decreasing and then increasing rate, which follows the decreasing and increasing marginal costs that we've been working with so far. So the Greek letter pi is a curve representing the profit, which is the difference between the total revenue and the total cost. The horizontal line at pi sub a is the minimum level of profit that a firm is willing to make. So a profit maximizing firm would produce at q pi. This is where the profit is the largest. If they chose to simply maximize their revenue, however, they would choose the peak of total revenue at point QS. But note that the profit level when the firm produces at QS is below the pi sub a, so the minimum profit level they're willing to deal with. So the firm would not choose Q sub S. That'd be a bad choice. They would instead choose Q sub a. This is the highest revenue possible that's at or above the minimum level of profit. Now, there's an interesting implication of this model, which I mentioned in the previous slide, which is an effect of a change in the fixed cost on a firm's decision. So under profit maximization in the short run, a change in fixed costs is not going to affect the firm's decision making at all because neither marginal revenue nor marginal cost is being impacted. Remember, the rule is marginal revenue equals marginal cost for a typical profit maximizing firm. However, in this model of revenue maximization, if the fixed costs increase, that's going to shift up the total cost curve. And we see that here with the total cost curve with the new slightly higher dotted line. What that's going to do is lower the profit, so that line is going to decrease by the same amount to the new lower dotted line. What we're going to see is the firm reduces their output so that it still satisfies the minimum profit level that they've set for themselves. So in this case, instead of producing a QA, when fixed costs increase, they're going to decrease their output down to Q sub n.